All right, everybody. Welcome. End of the week. Great week here. Happy Friday. Happy 3-day weekend Friday. So Monday we will be closed. Um, let's see here. I'm going to go over an agenda real quick. Just some Q&A that you guys might have right now and that I received through the week. And I appreciate the kind words and of course the questions. And there's nothing more valuable in your training right now than asking the questions that you have, okay? Or even just jotting down things that you notice. So we're also gonna go over some trades. One that I'm still in right now, so I can't pull over my data feed. But also two things. I might have a conflict in about an hour, but if we don't, then we'll go through some live data feed training or maybe some replay. But I think the market might be active enough to do some live stuff. Okay, so let's start with some Q&A, and I'm going to start with a couple of questions that have come across, and it's going to be, let's start with the timing issue. And no, Peter, no FDAX. That's not one of our recommended markets. Okay. So our recommended markets are first and foremost the S&P, the 10-year, the FGBL, and the Bund. The Bund and the FESX. Those are our primary focused markets, thick markets. Okay? It's all about transparency. You got to have transparency. Our secondary markets, if you're really going for it, is the crude and the Russell. I would recommend you focus on the top tier in your training. You can always trade the crude, the Russell, okay? Now, that being said, the third tier markets, which will come as you grow as an order flow trader, can include things such as the DAX, can include other commodities, wheat, you name it, currencies, spot currencies, stocks, and ETFs, options, okay? But the better process is to go through the first tier, then the second tier, then in the third. There's no reason to learn something that's brand new to most of you on a really fast, quick market like the DAX, or even crude and Russell for that matter. Okay? So I want to go over time, and the number one thing about trading, everybody, and the reason why we can share this information and this strategy and it's not going to affect our success rate or it's just not going to accept it's not going to interfere with the markets or the strategy. That's not that doesn't really work. That's not reality in real life. Okay, I know that people would say that then why do they have algorithms that are hidden? Well, the big reason why they're having those hidden algorithms and things like that is because they're very expensive to keep and upkeep. But that's all. The only thing that is not subjective in this business, because this is a very subjective business. It's painting pictures, okay? It's impressionism. And the only thing that's not subjective is how the market operates. And that's why we focus, and that's why I particularly focus on helping you understand what makes the price go up. Is it price? Is it volume? Is it liquidity? Is it lack of liquidity? Is it aggression? Things like that do not change. And the common denominator to all of that is fear and greed. Okay? Fear of missing out, fear of losing, greed. Everybody's doing it, so I might as well do it. Everybody's bought it, I might as well buy it. Everyone's talking about it. Don't want to miss out on that. It's just over and over and over, the same old thing. Now, when it comes down to timing, it is subjective. You really want to focus, and the most important thing here is to take the underlying concepts of the market. And again, the underlying concepts of the market is called the dual auction market theory. Dual auction market is how the market operates, where if there is a seller who wants to sell at the bid, someone has to be willing to sell it to you at the bid. Okay? And when you put out a bid, it's going to, you put that out into the market, it's a market order that's going to take that bid first. Okay? And that's the worst price. So you really want to I want to parlay this into, who are you as a trader? What kind of trader are you? And I mentioned, now this is a process, by the way, to figure out what kind of trader you are. You're not going to know this right away, okay? But what I am personally, I am a wholesale trader. What kind of trader are you? Now, how did I come out with this wholesale trader? And I'll tell you, I don't buy anything in life at full price. I never overpay for anything. I always have to feel I'm getting a deal, even if that deal is just momentarily. I have to feel I'm getting a deal. So that means I always want, if I'm going to buy something, I want to buy it at a discount. If I want to sell something, I want to try to get the best price. Okay? And that's just, I've come across this because that's how I shop. I'll go into, if I've got to run to the store, the grocery store, and I don't know what I'm buying, but I'm buying a few things, and there's a selection of, say, cheese and milks, or orange juice and things like that. I'm looking at the shelf, and I'm looking for the one that's on sale. Okay? That's how I'm doing it. I don't care about brand when it comes to food or things like that. I'm not a Whole Foods shopper, right? I buy more than 80% probably. If it's not on sale, I'm not buying it. I even do that at Costco. I'll go through Costco, and if it's on sale, I'll take a look at it. Now, I may be a sucker for doing it, but that's just who I am. So for instance, when we get a week or last few weeks that are selling off heavily, 200, 300, 400, I don't wake up and go, I don't wake up and go, oh man, the market's down again, I'm losing money. No, I don't. I go, yay, I'm not retiring for another 30 years. I'm happy that it's selling off. And what I did all morning and yesterday, all I'm doing is looking for dividends, stuff that pays yield. And I'm looking for markets that are just beaten up, kicks out, kicked to the curb. And the number one market that's kicked to the curb right now is energy. Now, when you're doing this, when I'm a wholesale trader or I'm buying a discount and I'm looking at eggs or milk and I see it's on discount, what's the first thing that I do? What's the first thing you think I do when I look at milk or eggs or something that has an expiration? I look at the expiration on it. I'm not going to buy it at a discount and it expires tomorrow, right? So I have to still buy time. So how do I buy time when I'm buying something at a discount? I buy yield. I buy dividends, something that's going to pay me. Something that's going to be allowing me to hold. Allow me to hold this stock or this option or even this commodity, okay? So circling back, who are you? What type of trader do you want to be? Are you a buy and hold trader? Are you long term? Are you short term? Are you a scalper? Well, I am all of the above. But all of the above, the foundation is I am a wholesale trader. I buy things at a discount. Now, how do I know things are at a discount in the market? Okay? Well, I know that through time. That's all. So how much time do I need to figure out value? I don't know. I don't know the answer to that. It could be 5 minutes. It could be 15 minutes. It could be a half hour. It could be weekly, daily. It could be volume, tick, range. I don't know. That is subjective. But all I'm looking for is value, whether it's a 5 minute or 15 minute or a half hour or an hour. That's all I'm doing. Now, what I will do is I will take, because I know that the market works on the dual auction market theory and not a time frame, I will look for overlapping value. So let's say the value of the 5 minute is as such, and the value of the 15 minute is as such. And I see the overlapping two values here. I see overlapping, right? I see that as overlapping value. Then I'll go to the next 30 minute. There's value, okay? So then now I can expand this value, right? Then I go to the weekly or the daily or the 4181 tick chart or the 25,000 volume chart, you name it. And I see value as up here as an example, just as an example, of course. I'm going to encompass this entire here, here, this bottom of the range, all the way up to the top of this range, okay? That's how I find value over time, okay? Any questions so far? Okay. So how do I qualify? How do I qualify this value? Now, if I am a wholesaler or a dealer, okay? If I'm a wholesale or a dealer, now a little bit more about my background is when I left Wall Street, or I left the firms, and I didn't want to be a part of what was happening. And for any of you who saw The Big Short yet, I went and saw it last week, and I was ill to my stomach walking out of there. It made me so sick, okay? Let me get rid of this. I was sick to my stomach because I was one of the few that saw the writing on the wall. And I was able to leave before it all came crashing down. And then I was able to take advantage of it. Excuse me. So then when I finally got out and I was just watching the market crash because you couldn't short anymore. It was illegal to borrow and sell those financial stocks as they all got to about 30 bucks. Then they all went to about zero or equivalent. I was like, okay, what am I going to do with the rest of my life? I was only, 35, I guess, 35 maybe. Yeah, 35. What am I going to do for the rest of my life? I got out of there with a good retirement. Didn't, the stock, the Bear Stearns stock was up to 120 bucks a share. I didn't write it down to $2. I had some money, and I was in the position to decide. So I was like, you know what? I really like fine wines, and I wanted to become a dealer in that trade, but I had to learn more about wines and become proficient at it. And what I did is I wrote out a business plan to look for investors, and the business plan entailed investment grade wines. So I go back to what I know, which are the markets, and how the dual auction market, everything you do out there, everyone's familiar with an auction, right? It's the same thing. Well, looking at fine wines as an actual asset class, and I would call it liquid assets. And I would look to acquire fine wines in cellars at a discount. Now, how would I get a discount in fine wine? Well, the good thing about the markets crashing in 08, 09, through 10, etc., is people were starting to liquidate all kinds of assets, art, homes, collections, wine. So that's what I did. Bought up some fine wines, drank some of them, held on to them, bought some time basically, and I resold them. 300% markups. Okay? That's what I do. That's who I am. I'm not a momentum trader. I don't buy breakouts. If I buy a breakout, I have to have a reason to believe, and just as a market maker would have a reason, or a trader at a firm would have a reason. They have other information. If I'm not privy to that information, I'm not going to put a big bet on it. But I need to quantify where is value. Okay, so if I have value here over this time period, 5 minute, 15 minute, 30 minute, 1 hour, I'm going to be looking for opportunities if this is continuing to, as you can see, the value here is actually shifting higher. So what that means in a dual auction is the valuations are being accepted. The higher the prices go, the acceptance. How do I know they're being accepted? Okay, because price itself, price is holding here. It's not only holding, but then it's rotating around, rotating price, and then it checks lower first, then it goes higher. Finds another level, rotates, checks, and then heads higher. It always checks lower before it goes higher in every one of these time frames. So this is really, really important to your thought process as an order flow trader. Okay? You've got to get through just the buy and hold, and through the momentum trading, and through the indicator trading that you relied upon in the past. An example of an indicator trading that most people don't know is an indicator is called a candlestick chart. Candlestick is an indicator. It's a derivative of price action. Okay? And you don't get the complete picture. So that's why we never used things at the firm such as candlestick charts. I didn't even know what candlestick charts were from 1994 when I got started, from 1994 all the way to 2000 and I believe, yes, 2006. I had no idea what candlestick charts were. Zero. Okay? All I knew is what order flow was, where orders were. That's all. I knew what the value of something was. I knew what the supply and the demand was. Okay? That's the kind of trading I want to, that's the kind of trading I want you to, that's the kind of trader I want you to evolve into, a dealer trader, a wholesale trader, a market maker trader, not a trend trader, not a scalper, not a buy and hold. Okay? So going through this here, I want to talk about when are you going to find those opportunities. And I'm still in this gosh darn trade. I can't get out of it yet. Let me just tighten up the stop, as it looks like it's ranging and it's not going to go anywhere. All right. Let me see here. Let me go ahead and just get rid of this stuff right here. Okay. Gosh, I really need a chart for this though. All right, I'm going to mark off. So this is still on the subject of time. Okay, timing. Now, does everybody follow me that the market, and basically the bigger participants, they don't trade based on time. So they don't trade based on 5-minute charts, half-hour charts, you know, they don't even trade based on tick charts or range charts or all that kind of stuff, right? They don't. Does everybody understand that? It's order flow. Order flow happens when a trade happens, okay? So I need to, so timing is all based upon the value and then how to quantify that value. How we're allowed to quantify value these days is through volume over time. So I have high periods of volume, low periods of volume, high periods of volume, low periods of volume. That's how we quantify it. And that has not been readily available at this level forever. Okay? Now, what we want to do after that is we want to understand the liquidity of the market. Liquidity, this equals liquidity, and this equals liquidity, and this equals lack of liquidity. Okay? Now, this can be any time frame. This can be the 5-minute, this can be the 15-minute, this can be the 30-minute, right? This can be within, now that we have the information, this can actually be within a candlestick, and you're going to get a distribution of how much the trades occurred at. And you're going to get, and you're also going to see, you're going to get an idea of who initiated that trade and where they initiated that. Now, knowing the purpose behind, if I'm looking to sell something, I'm most likely going to be a buyer down here. But I'm going to buy only after I have a sense that it's not going to continue lower. Now, how do I know that's not going to continue lower? We went through this last Monday. We went through the sequential declines, okay? The SQDs. So on the SQDs, this sequential decline, it transcends all time. In other words, this can be applied to 5-minute, to 15-minute, to half-hour, to 4181 tick chart. Whatever you're comfortable, whatever you're going to need, you personally, to feel that you see value and to feel that you're getting a good price. So that's subjective, isn't it? Because there's some people out there that would love to overpay for something because they say, well, everything's priced into the, everything's priced in, the supply and demand is priced into the commodity or the stock. So therefore, it's all good. It's most likely going higher. But we all know now that nothing goes straight up. Nothing goes straight down. There's always opportunities. So you can have that same idea, but what I suggest is taking a look at the sequential decline to see that sellers are actually every price tick lower. It starts to get too cheap to buy. Now, here's an example. Here's a quick example. I'm out. Okay, I'm out. Let me start this thing. Any questions while I load this? Let's just do a tick chart. Oops. How about a volume? I'm talking volume anyway. Let's do volume. How low will the market go? How low? I don't know the answer to that, nor do you need to know the answer to that. One of the things I don't do is predict. I can't predict because I'm not a psychic. I don't know everything that's out there. And even when I was at the firms and I had all the information in the world, I didn't predict. I just searched. I just looked. I looked for value. I looked to quantify. So how would you look to quantify how quick or how low the market would go? Let's just say, for instance, I don't know if I can bring up. No, I don't think I can. I don't know if I can bring up. Yeah, let's just bring out something that's getting crushed first. Okay. Yeah, I don't recall if I have data feed for that stuff. Let me. Okay, let me try. Well, that'll just take too long, actually. Okay, let's take a look. Something that's been beaten up, obviously, is oil. Energy names. So, how do I know it's starting to get too cheap? Am I buying? Am I hedging and buying for containers? I don't know. I mean, no, I'm not. Who is? People that's their job. They have to buy. So in a bad market, the market that led us up real quick yesterday were the oil service companies. They took a big pop. They were the biggest performers yesterday. So it tells me that they're starting to buy, right? So either the big boys, and we've talked about this Monday and probably every session that I've ever done, is that the big boys don't sell. They're not selling down here because they sold way up here and through here, which is basically will align with liquidity. Okay? When it starts to get down here, we're looking at in oil, we're looking at stuff that's 7 years ago. Prices of 7 years. Now I don't have access to that immediately. I have to go to a different platform to find that kind of information, and that's how I would look to quantify the levels. I could do that if you guys want towards the end, if you're really interested, but just know that we can't instantaneously have access to 7 years of data when we're trading. So the odds are you're going to have thin data through here. Okay. So how do I decide if it's too cheap? Well, the sellers I know sell up here. They're starting to sell less here, less here, less here, and then it gets to the point where it just gets too cheap. So on any opportunity, they buy big and they run price, right? Now, in order to run price, they first have to absorb all these sellers, all of the inventory of the sellers. Then you'll see a pause, a pivot, and a launch. They rarely go straight down, straight up. And I want to show you how to see that with the NOFT. So let me first go back. Let me build this another chart just so that it starts running. Now, for instance, Mark, on Apple, how do I find out a price of Apple that I'd be willing to buy? Well, what I do is I took into consideration how much cash Apple has and how much technology or how much a new product or a product actually moves the price of Apple. And in my opinion, Apple has so much cash, it's just like a bank. So I say it should have a valuation similar to Goldman Sachs. So if I put a Goldman Sachs valuation on Apple, I get south of $88 a share. Okay? So that's the price that I believe Apple is a buy at, is 88 bucks a share and below. Exactly. And I also know the law of numbers. The law of numbers are when something gets too big, $1 trillion market caps and all, you know, it can't go up forever. Okay, so now let's look at this as, okay, if I don't have 7 years of data, or if I don't have all the information that others have, then I can only rely upon, at every price, I'm seeing less and less sellers. I'm seeing buyers. I know the institutions, how they buy, because I was on that side, so I understand that part of the game, and that's why I'm sharing this information. I know they're more willing to buy down here, but one thing that they have that we don't have is they have time, and they have a lot of capital, and they buy in such big amounts that they have to leg in. They have to. They can't buy everything at once. Okay? So there's an example of when a rally happens, the biggest performers are the oil. That gives me an idea. Okay, well, they can move markets. Most likely they're dipping their toe. Now, that being said, that's not going to be the bottom. I don't believe it's the bottom, nor do they. So I want to look at price in relation to value. And if I don't have volume to quantify that value, then I have to do stuff like adding, because remember, we are, primarily we are day traders, right? Primarily. What you do with your real money is put them into assets, whether that's home, your equity in your home, long-term assets, you name it. But this is just income. So I can add, how do you add an indicator again? Sorry. Let's look at true value, and then let's look at VWAP, and let's look at let's just do those two right now. Okay. So, oops, I meant to put it on crude, but we'll just use this. Let me get more volume on here. So I can see 2 days. Oops. Okay, here we go. 2 days worth? Yeah, 2 days worth. All right, now I want to take a look at the standard deviations away from value. In this case, I will go ahead and increase, indicator, VWAP, I'll just go 0.8, 1.5, and 3. And then at the VWAP, I will put it as a thick black line. Okay? So we're going to look at VWAP, which is the black line, and standard deviations away from the black line. Okay? And as standard deviations get away from, as the market price gets away from, on the bottom side, seems to tag here, tag here, tag here. Okay? On the top side, tag here, break through, support, came through, and then the slope of the value increases. Okay? Then the very next day on the open, it's obviously easier to see after the fact, but I want to show you what I meant by the price checks. The price checks higher before it goes lower. The price checks lower before it goes higher. Everybody follow me? Because it's a dual auction. So if I have the opening range here, let's draw out the opening range. Okay. Oops, that's not the opening range. Excuse me. Sorry. 24-hour chart. All right. Shoot. Well, this will work. But let's just do the opening range here. Okay. Now let's go into it and let's deduce the thought process before it goes higher and what you're looking for. Okay, here we go. So remember, before it goes up, it must check to see if there's any more. First of all, it's checking to see not only if there's buyers. That's the main thing it's doing, checking for buyers. Are there buyers interested? The answer is, you can see here, wick, wick, wick. Answer is yes. Are the sellers done? Are they slowing? Well, they may not be done, but are they slowing? Well, they sold here. They sold here, right? How do I know they sold? Because obviously price went down, but they also ranged and created a fair value and initiated sales outside of value. Then it ranged, then it initiated, then it ranged. And every time it's checking, I'm looking to see if the sellers are sequentially declining, if the prices are, if the number of sellers, the volume or the number of sellers hitting the bid or selling every tick lower is getting less and less as one. So that's a sequential decline, right? Sequentially declining sellers. Now, again, it doesn't really matter what time frame that's on. It's whatever time frame I'm comfortable with. I see value here. I see value here. What else can I say? What else can I say going into the open? I can look back and I can go, okay, look, the volume weighted average price is way out here, way up here in this area. So that automatically tells me where the institutions are looking. And that tells me that they're most likely not going to be selling that far away from the deviation, that many deviations away from the VWAP. So let's see, it lines, here's the 0.8 standard deviation, here's the 1.5 standard deviation, okay? Now, how do I know it's going to stop on the 1.5 versus going all the way to the 3? I don't, but every time it checks, every time it comes into the 0.8, I'll check. 1.5, I'll check. 3 standard deviations, I'll check. Because on average, markets move between, most likely, they normally don't exceed 1.5 to 2 standard deviations away from where all the value or the volume is being done. So again, I'm bringing in the fact that this is how the market, dual auction market operates. So, and I want to trade the market. I don't want to trade my opinion. So I need to quantify and qualify where's value. And we have the tools to do it. Am I being too long-winded? Am I getting through? And any questions? Are there any questions? It doesn't, I mean, again, we have to think logical. We can't think emotional. That's cool. We can't think emotional. But the auction market needs to check lower to make sure there's real buyers. And we know how to quantify that now, right? Now, I'm going to share with you a couple things. Let's get rid of these real quick for the moment. Okay, so I'm sorry. So that's one of the ways that we're checking value is to have our tools, okay? Another way I do it if I'm in a situation like crude or anything else is I'll take a fib extension and I'll draw it from just, a low to a high or low to a high or low, whatever. And all I do is just, I'll eyeball it. I don't even have to draw these anymore because I can pretty much just eyeball them. And I go, okay, well, listen, there's a little bit of a confluence here on the 618 extension at 1870 with the VWAP. So that could be a target. That could be a target and a rejection opportunity. That's all. Something like that, okay? And that's how I'll use that. And then I'll say, okay, what is the volume composite on that? Let's go with the volume composite now, and I'll add volume composite, volume NOFT true value composite. Okay. Then I'll go, okay, I have not sure why it's not loading. Okay. Anyway, what I will have is I'll say, okay, I have One reason, shoot, I'll have one reason, because remember, I don't know where the market's going to go. I don't know where they're going to buy. And you have to get that into your head that you don't need to know. You don't. You have tools now that'll tell you, and they'll tell you before almost everybody else, because we know how to anticipate. We know what a turn looks like. We know what a reversal looks like. We know what a breakthrough looks like in the numerical form and not a lagging indicator. But what I would do is I would look for the volume profile. So obviously there would be a little more volume here at the VWAP. And I would look for the nearest and lowest LVN. Okay. So then I would have, say, a 618. And this is just, giving me reasons to, now however time frame, now I'm not talking about time frame, whatever time this occurs in, whatever time I can quantify value personally. Okay, so however I'm doing that, then I have 1.5 standard deviations, and now I have an LVN. I have a reason. I have a logical reason that if I start now at that level, I start to see buyers sequentially declining, buying less and less as the price is going up. Then I check for value. Where's value? Is it left behind, or is it near current price? If it's near current price, well, I have to be cautious, because I could be in a situation where I have stair-stepping value higher and higher. So in order to find the opportunity, I'm going to say I want to see sequential decline, and then I want to see a rejection of the high. So a test, a rejection, and then I want to see it come beneath information. I want to see it come beneath the COT or a seller, an imbalance, right? A buyer-sell imbalance, or a block trade, or something. And then I will take the trade after this around one of these as a level to short. Because if I can identify value or aggressiveness, then if I'm wrong, I can put my stop around one of these guys. Okay? So now here's in addition to that, and this comes still on timing, you guys, still on timing, okay? Let's go to timing. I want to share with you a couple things, because the 2 o'clock question came up yesterday, and I want to identify what happens at those times. Just a second, please. Okay. All right. So time. Well, obviously we have an opening, right? On the S&P 930. Okay. Then we have a consolidation that happens at 9:45, and that becomes a trade opportunity. Okay. Then at every top of the hour and every bottom of the hour, we have opportunities. Okay. Then we also have a 3 a.m. opportunity. okay? And I want to show you that every single opportunity is going to go through the same process. It's going to consolidate or range. It's going to check the opposite direction it needs to go. And that, it's like the market has to, remember the market's job is to bring buyers and sellers together, okay? It's got to make sure it's brought on board all buyers and sellers. Now, sometimes it's left with unfinished business. That means that may be an opportunity for a future trade. But we also have another time. We have between, it's on East Coast time, or excuse me, East Coast time, it's, well, anyway, 11 o'clock is 1 o'clock, right? Yeah, 1 o'clock. So 11, 12, 1. 11. Okay, this is margin calls. Gosh, when did we used to get those margin calls? 11 o'clock till about 2. Let's just say 2:30, okay? And let's just say 1 to 2. They're margin calls. And you can only avoid the risk manager for so long before they just kick you out of the trade. So every single opportunity, 9:30, 9:45, every top of the hour, every bottom of the hour, and 3 a.m. and margin calls. Now I want to show you just on a regular chart. Let's do crude, just because it's empty. How do you get rid of these things again? Remove. Boom. And then I need, okay, here's a 3 o'clock. I want to mark off the range of, it's 11 o'clock. Sorry, 1 p.m. Eastern Standard Time. It was 11 o'clock my time. Okay, let me first identify for you those times. Where's the vertical one? Here it is. Okay, and I need this. Okay, so we're gonna go with vertical 3 o'clock. Okay, then I want to go with obviously opening, and that 9:45. Right, let's see, open. Okay, then let's do. Oops, geez. Why don't I just do this? F7. Okay. Now, can you guys think about something that happens every half hour and every hour? What do you think happens? Yeah, absolutely. New money. A transfer of money occurs. Okay. So we have the 3 o'clock, and that is the London Open. That's the first liquid opportunity. Okay. Now the London Open becomes, if it's trading beneath, if current price is trading beneath, this becomes resistance. If it's trading above, this is support. Let me just get more data. guess I have to go, I first have to find, let's start from the beginning then. What just happened? Where is crude? Oh boy. Okay, I'm sorry. I lost it. Let's go with this. This is crude. Oh, this is crude, excuse me. Okay, let's just mark off this range here. So that's the first opportunity for liquidity, right? Is the London Open. So we'll take that range. We'll extend it out for the day. Okay, 3 o'clock, 3 a.m. Remember, there's a range. There's a range. It's ranging. It'll check lower before it goes higher. Sorry, guys. Ah. I'm going to just show you the wick. Gosh darn it. Okay. All right. Here's the range, 3 o'clock. Does everybody see this little wick right here? See the wick right here? See the wick right here? Notice it traded beneath the previous low. Then it got long. So let's just do the first set. The first set, that's the flush. Exactly. That's the flush, you guys. So there's the 3 o'clock. Now let's go into the opening. Okay. So as we're coming down, we have the 3 o'clock, right? Boom, right here. It stops, flushes, comes through, checks the other side of value. Okay? Checks, checks, runs. Now, look what happened. Look what happened at you got to look at what happened before it traded. Is that it? No. Okay, there's the flush. Goes up, comes back down. Now, all I'm saying is that this area, gosh darn it. I don't know what happened now. This area is liquidity. You guys get the idea, don't you? Okay, guess this is it. I don't know. Anyway, sorry about this. I'm having problems here. Okay, retail flush. Retail flush. Retail flush. Retail flush. Retail flush. You got it. You got it now, right? Is there anybody that doesn't know what the retail flush is? You don't? Okay. Retail flush. Let's look at it as, let's now look at it on an off chart. Oh, look. Retail flush is getting all the sheep, getting all the sheeple to sell. Getting all the sheeple to buy. Okay? Everybody starts to jump on board and do the same thing. I thought I put out, here it is. I'll show you what a retail flush is. Now, I nicknamed it that. It's not really, I don't know if it's a valid term or not. There's probably other terms for it. But we used to call it at the firm, this guy named Tommy. And he was our indicator. We called him Top Tick Tommy. And they kept him because he owed the firm so much money. Hundreds of thousands of dollars. Also, his daddy was, super, daddy's account. Anyway, if he was our live indicator, exactly. If he was selling, we were looking to buy. If he was buying, we were looking to sell. Okay. So this is where a red bar, so this would be a negative bar, this gray bar, Gary, okay, and it prints a low, okay, then you wait for the very next bar to open here, then trade lower, because it's making lower lows, right? We're making lower lows, a lower low, a lower low, a lower low. We're making lower lows. So we've got the trend followers, the sheeple. The sheeple, what are they doing when it's making lower lows and lower lows? They are selling, right? Now we don't know when they're going to stop selling until we can quantify it. So sell. Okay, every single time it's going lower, I start looking for information. Here's a piece of information here that shows up. See this 244? It went lower beneath the previous low. The market, all the market is doing is trying to find buyers. Buyers, that's all. Once it does, finds buyers, it trades up and around a few things that we're looking for. To positioning of value, where's value? Okay, maybe there's a heavy seller in here, a large number on the sell side, and I don't see, but that does occur. And price itself starts to trade around sellers and value. And this seems to be an initiative buy. Excuse me, I'm sorry, pardon me, that's wrong. This is a responsive buy. So the sellers initiating are not initiating any longer. The buyers are responding. They're buying, 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 responsibly buying. Then it trades around something, a block trade, value, and then it takes off. And all of the people selling here and down here have to cover at the ask. They get closed out. Okay? Now this happens. Let's just say it happens the majority of time. Okay? So, timing. Every single time you come into the 3 a.m., throughout the day, the 3 a.m. level, or the bottom of the hour, or the top of the hour, you're going to have a convergence of time. The 5-minute, the 15-minute, the 5-minute, the 10-minute, the 15-minute, the 60-minute. They're all going to converge. And the more people out there that actually buy the break of the previous low, or they short the break of the previous low, or they buy the break of the previous high. There's always a potential that a trap is being set. If you can identify that trap, you're in it. Okay? The sheeple get run over. And that's what I do. I wait for the sheeple to get stuck. Right on. Right on. Because if the sheeple are just selling, and I'm a wholesale trader, I'm not getting a deal if I sell. Because I can't predict the future. I don't know that it's going lower. Follow me? All I know is that value, the last part of value was, let's say here when it ranged, or the volume weighted average price is up here somewhere, or some quantifiable reason to say, okay, that's where value is. This is where the initiative sellers are. They don't initiate sells down here. It's responsive buyers that do. And they have to, responsive buying is absorbing the sellers, pivoting the market, and then initiating trade. Okay? All right. Now you're gonna have a very tough time doing this on a fast market like crude and a Russell. But let me tell you, it's gonna happen all over the place. All you have to do, that's why this became my bread and butter trade. All you do is sit and wait for the rejection of the previous bar, and only when price trades around something that's measurable beneath the value you can short. Okay? But always keep in mind, bottom of the hour and top of the hour. You're gonna get an opportunity, because you're gonna get the opportunity where price near top of the hour is going to start to range. Or see, so the flush occurs here. Trade beneath. So one of the questions that came out was, a couple questions, is trading value area. Okay. Value area edge is the only location providing, I don't know what that word is, of certainty. And the only certainty that I have is that I'm not buying or selling in fair value, because that's what this is. If price is rotating around a number, oh, thanks. If price starts accumulating around a number, it becomes fair. That's fair. There's a value there. There's equal buyers and sellers. There's equal buyers and sellers because price is not going up or it's going down, it's going sideways. So it's fair. So if I'm a wholesale trader and I'm trying to get a deal, I can't, my deals are up here and down here, and that's it. So I'm going to wait. I'm going to wait for those deals. Now, how do I try to stop myself from becoming the flush? Is I wait to see the flush. The trap is being set. A trap is being set if I can't identify it the odds are I'm in it. What chart do you trade off of? I trade off of a dome, okay? I use the NOFT to give me levels, information. That's all. Information. Before this pivots, at near the top of the hour here's the top of the hour. It runs from, this is a volume chart, okay, versus a 5-minute chart. So it runs through here, pretty much top of the hour. Wait for the, do you know this very single bar right here? This very single bar is pretty much like a doji bar. A doji bar is an indecision bar. That is value. So the high and the low of that bar is value. And I'm looking for the trade, previous low, look at the buyer that shows up, trade around from the COT, and you have an opportunity. Are you kind of getting it? Do I use stochastics or MACD or momentum? I don't use momentum because what momentum, the couple things that I will use is, here is the IMF, institutional money flow. It's simply measuring the number of aggressive buyers. That's all. I'm not looking for stochastics overbought, oversold, although you can. I'm not saying that you can't. I've used RSI before. And all I do, let's say I'm going to use, something like that. Okay, all I'll do is go, let's say I do RSI, because that's something I did do. Now, I'll do it on a short period, and the default is usually 70-30. Okay, I will extend that out a little further. So I'll say, okay, where's the 70 mark? 70, 70, and 30. 70, 30, okay? So I want to see 80 and 20. That's when I want to look at the opportunities. Let's take a look. Okay, here's the 70. This is when everybody else, here's the 30. This one is when everybody else is buying, right? Here's the 70 here. This is when everybody else is selling. Here's the 70, here's the 30. So I would be interested in this area. This area, when he hits the 20 line, 20 line, 20 line, 20 line, not the 30. Okay? When price moves through a level, do you step back and try to fade it? Okay, we talked about that. That's retail flush, right? Do I look at candle patterns when entering? And the answer to that one was, no, I don't look at candle patterns, okay? But I am aware of the candle patterns. And why am I aware of the candle patterns? Because 90% of the retail traders, the sheeple, know candlestick patterns. So all I'm looking for really is the double bottoms and the double tops, the triple bottoms and the spread triple tops, okay? I'm not looking for heads and shoulders and, shooting, I don't know, hammers and stuff like that. I'm not looking for that. I am aware of it. I don't use it. I don't use it to get into a trade. I use it to take advantage. How much time? Oh, 15 minutes. Okay. All right. So there's a couple things, you guys. Always keep aware of where value is. Always quantify it. Always quantify your trade. So instead of taking a short where your stop could be 15 ticks, 20 ticks, 30 ticks, or a few points for most people. If I get something quantifiable like the sequential decline, the COT, an aggressive block trade, an aggressive party, I can use that to lean against. Am I pretty darn clear here? I'll show you now using the NOFT. Okay, because what you're going to find, guys, is that it's going to be, again, it's going to be hard to do on a fast market. Once you get good at this, literally, you guys, it's the only thing I see. All that I see is sheeple. And I'm looking to take advantage of the opposite trade. That's all I'm doing. That's all that I see. So I recommend you get to the point in your practice to make that all, that could be something that you see as well. Just like when there's a new car, like the new Tesla or something, and you see one of them, all of a sudden you start seeing a ton of them. That's all you see. You can become blinded, yes. So how I stay from becoming blinded is I make sure that I check to make sure there's something quantifiable before I take the trade. Does that make sense? Now, one last thing you can do. I'm going to show you on a trade that I did before I closed it out here. Okay, here it is. All right. Okay, now let's talk about quantifiable. Okay. Again, it's a downtrend, right? How do I know it's a downtrend? It's making lower lows, correct? Everybody follow me? Lower highs, correct? Now, what happens? A couple things. Sequential decline. Sequential decline. The value is up here, it's migrating lower, and then it pauses. It stops. Kind of oscillates, right? What do I start to see now? A little bit of buyer here, a little bit of buyer here, a little bit of buying here. That's called responsive buying. Responsive buying. And I say, okay, that's cool. I'm starting to see stuff. Oh, guess what? Look what else I have. Look at this. See this line right here? That's a homework level. That's a homework level, which is pretty cool. That's a homework level. So I'm already thinking, okay, well, we're coming into a homework level. We're trading above it, so that means I'm looking for a long. If I was trading below it, I'd be looking for a short. And I start to look for clues. Now, here's one of the easier clues, and to slow down the market. Now, this is the long bond, so it's already slow. So I'm finessing the trade using the dome. But if you want to slow anything down like the S&P or the Russell or crude, you can wait for the up bar first. Just like I said that, I don't know. The market doesn't even know if it's going to continue lower until it finds buyers. So trading the low, look at here. Look what we have. Looky. Retail flush. Now you might be thinking, well, what about the previous ones? What about the lower lows there? Right? Well, there's a couple things. This is not a location. That's not the correct location for me to take a long. This is the right COT. But to take a trade, I'd have to take the long all the way up around here to get long. So that doesn't happen. Then I see a lower low here, and I say, okay, potential retail flush. Here's something to lean on. Here's something to lean on. I can get long in here. Or to slow it down even further and to avoid getting sucked into it, you can wait for the down and then the up move to show you, let the market show you where it's going. Stop trying to predict anything. Have the confidence that you don't need to predict, you don't need to guess. You have the right information. Okay? Look for the opportunity. Then, what I've been trying to show you guys in that anatomy of an auction document is you don't take the trade on this bar. Don't take it. What you're going to look for now is 1, 2. Look for the buyers. Notice how I drew, see these green lines? I draw these green lines. See this 297 here and this 157? I simply drew and connected a trend line of aggressive buyers. So this here works, this here works. You can get long. It can come back in. I'm looking for, I actually got in, I missed this trade here. I missed that trade there. But if you even look where I did take the trade, something very similar occurred. Traded beneath the low, came back around COT, and I bought. One tick around that COT, one tick. So again, I have the opportunity to anticipate because I know what to look for. I know what the sheep will do. And that's why all of you guys, before you're coming into this deal, you're going, yeah, I use hard stops, but every single time it's like they know where my stops are. They don't care where your stops are. They just know that the way the sheep will work. And that gives them a higher probability of liquidity. And the market, the big players need liquidity in order to run a market. Okay? Now, as this is going higher, I want to show you, I start simply hiding my stop behind something, right? I hide it at a buyer here. I had it at a buyer there. I broke it up. I go to the next one because I took just a quick snapshot because I took another. I moved it again. I moved this. It went higher. I don't know how high it's going to go. It just went higher. So then I hide behind the 34 here, and I kept my last here. Then this is before it finally stopped. Okay. See, it was at 34. It kept going higher, but I do see sequential decline now coming in. And I start to see sellers now. Notice there were no sellers in here. Now I'm starting to see sellers. So sellers are responsibly selling now. Okay. We're starting to get closer. Here's a standard deviation line here and here. Okay. So sellers start showing, sequential decline starts showing. So I move my stop behind a buyer. I get taken out, and I'm hiding the last one now behind a buyer. I get taken out. That's it. So again, if we broke this down into the sheeple mentality, and we say, what is this that we're doing? We're working with the market. The market's simply going to check lower after it's making lower lows and lower highs, and you look at every single chart. And let's just say it's the majority. I'd hate to say it's 90%, 95%, 95, 99%. But you know what? Let's say it's 95% because I guess I hear that's the failure rate of trading. But let's say it's 95% of the time you're going to find the lower low before it goes higher. Okay? Okay, so responsive means that value is left here. Okay? That's value because it's simply oscillated, volume traded, there's equal buyers and sellers. When there's an equal buyer and seller together, a transaction happens, and that's considered a value. Okay? Then when price trades away from outside of value, that's initiating trade. And in order to do that, they need to absorb all the buyers within this inventory, and they need to aggressively sell to move it outside of value. Then when market moves away and it leaves value above you, well, guess what? You can look left somewhere and at somewhere in history, whether it's 7 years ago, someone was buying crude and they were oscillating before it moved higher. It's going to come down to check. The market is auction market is the market is only going down to look for the other side, which is buyers. So these buyers are going to start nibbling because they felt there was a value, even if it's 7 years ago. There was a value opportunity, okay? So they're going to start nibbling, responsibly buying. In order to do that, they have to absorb all the sellers. You can't, remember, the market is, for every buyer there's a seller, right? But what that means is it's not equal. It's not a seller and a buyer, okay? It's someone who's interested to buy on the bid has to be willing to sell it to them at the bid. So they have to cross over. They have to cross over to make that transaction. It's not equal. There's a divergence of a tick. So someone has to say, okay, fine, I'll give it to you. I'll eat the tick just to get the deal done. Okay? Yes, that's a good way to put it, Mark. Responsive buying means they're responding because they were a previous buyer. And that's what we follow in this discipline here. All we're doing with the NOFT is looking where were the previous aggressive buyers and aggressive sellers. And then we're going to simply take advantage of the sheeple. Okay? Now, in order to initiate the trade out of this, they have to absorb all the sellers here and here, all the sellers' inventory, before they can initiate and move it higher. And how do they break through a range? They have to jump over to the other side and become aggressive. And we saw that in a couple opportunities, a couple shots. Here's jumping over to the other side, right there. Here's responsibly buying. Here's jumping over to the other side means you're paying up. You're willing to pay up. Okay? And notice that these will happen a lot of times at the bottom of the hour, the top of the hour, and the 3 o'clock. And that's the whole idea. That's the whole reason why I like breaking it down for you guys. It's not about learning a new, let's put it this way. For everybody out there, it's about learning the market's true purpose. That's more important than anything else, than what time frame should I put my charts on? You know, what else? You know, should I use a momentum? Should I use a should I use a candlestick? Should I use the None of that ever matters. The only thing that matters is to learn to be one with the market. Everything else you can use just to be, you know, just to help you validate value. Okay? All right, you guys. Wow, look at that. Ended right on time, but didn't really get to do any live stuff. But okay, so let's take a look at this right here. Now, okay, so here is so you're starting to see on this right here, you're starting to see lower lows, lower highs, right? And we just consolidated, and we just hit. What did we just hit? 230 mark. 230. Ranging, right? Now they're going to flush it out. They're going to flush it out. Now, do I just jump right on board? No. I need something. So I see that they're responsibly buying, but I need to see price also. Just because you see numbers here does not mean they're aggressively buying, because they could also be selling at the ask. Okay? If I need to see them buy and I need to see the price, if they're really buying, then I should expect logically that price would be going higher. So that's how you stop from getting stopped out, or fall into the trap. All it's going to do is come back in, make that lower low. Now what am I going to use? I'm going to use this 412 and this 133 and this COT to get long. Okay? Now, what else do I see here to get long? I see the 202 and the 213. Let's just connect that. Now, what's my risk? Why should I have my finger on the close button, on the get out button? Why? Because it's a downtrend. They're just about to sell this thing off huge, right? But but why not take the opportunity? Why, if the sheeple are selling, why can't I just take the opportunity when it's so easy? Why shouldn't I? 202, 213. Now let's tighten up the stop behind 57. Now I'm tagging value up here. Maybe I see sellers. Maybe I want to let go of something or get completely out. Who knows? That's all you. So I let go of something up here. And I start to hide behind 57. Because maybe, who knows, maybe this is the low of, maybe we go back to Dow 25,000. I don't know. I can't predict. Right? Now all I got to do is just follow the guy up. All right? Follow him up. Follow him up. Follow him up. And how did this all start, you guys? A 230, consolidation, lower lows, buyers. Did the buyers respond in here? Yes, they did. I saw buyers responding, didn't I? But that may not have been true buyers. They may have been selling at the ask, right? Right? That may have been sellers at the ask. Because why? Because price didn't go up. And just because price goes up is one thing, I also need to validate this value. So I need price to trade around something. So I know what to hide behind. I know when to say, oh, I'm wrong. All right, I'll just close out. -1, -2, +1, +2, who cares? I'll look for the next op. But down here, I did start to see buyers, but they also held. You notice the buyers in here came around, but they didn't hold. They went away. And then if you want to slow it down and not get trapped, well, I guess look at this. I guess that's interesting, because if I look at this one here, these two, see the 482 and 426, right? And let's say I'm looking to get long on this one. I'd like to get long around the COT, and of course, because the sellers are in control, I want to get long around the 110. Get long around the 110 on this bar. So I'm one tick from getting in. But guess what? Let's say you messed up. Let's say you messed up and you got in. Slip of the finger, fat finger, you got in. Well, you also have a reason to get out. If it now price trades beneath the buyer here and the buyer here, you're getting out. What are you risking? I'm telling you, you're risking less than you used to risk. You're risking less than the sheeple. Okay? On that note, you know, right on. Have a good one, you guys. Have a great weekend. Have a great holiday. Nothing on Monday. So why don't you guys, you know what? There's a new group in here. So if you guys wouldn't mind, I guess, middle of the month, there's a few of you who went through the 2-week trial period, right? Thank you, Isaac. Tell me about yourself. Tell me about what led you down this path. Let's get to know each other. And then let me know what you want to trade. And I'd like to pair you up with another trader so that you can learn to be accountable. All right? This will truly help you guys. So send me an email, kwhitney@noft.traders.com. All right? Have a great weekend.